Hey guys, it's Maddie the Realtor here. It has been quite some time, I know. I'm happy to be back, happy to be able to provide some new information for you guys. There truly has been a lot that has been going on within the last year and a half. So here we go. I actually wanted to talk today about rate cuts, about low buyer confidence, what can increase that buyer confidence right now, and also what are real creative paths that are offered within the market because it is a different market. What kind of creative paths do exist for those that are wanting to jump back in? Now, if any of you guys have possibly been living under a rock, you might not know what's been going on, but really the last year and a half has been quite the ride when it comes to interest rates, when it comes to providing an environment where people feel comfortable to jump into the market. We have seen a lot of increase in supply, and I want to go ahead and let you guys know before I get into it. It's not necessarily that we have 100% a buyer's market because sellers are holding their prices. We have seen price reductions across the board. However, at the same time, there hasn't been that market crash that people have been anticipating. And there are so many channels dedicated to the market crash. Now, I'm speaking in regards to Central Florida. I do know that in different parts of the country, the type of market is looking different. But as far as Central Florida is concerned, we are sitting right now at about 5 months of inventory. A healthy market's going to see 6 months. Now, going back to pandemic times, we were barely a month. So you could see that things were flying off the shelf. And now that's not quite the same. And it has taken some time for agents like myself, listing agents, whenever I'm representing the seller, just trying to set those realistic expectations because we're not seeing things move the way how they did at one time. And there's nothing wrong with the house. A lot of times it seems to be priced properly, but even then, where are the buyers? That has been the golden question this year. Early this spring, we actually did see it was pretty flat spring season, and that has definitely everybody was hoping for a better spring season than what we had. The summertime was also extremely slow, and we're starting to see a little bit of an uptick now. Now, what's been interesting and why I wanted to dedicate the time to talk about this is because we actually saw the first rate cut since last year. So we saw a significant rate cut this go around that has seen a little bit of an uptick when it comes to buyers entering the market. Now, let's backtrack a little bit. Some of you guys might already say, I already know all this, and that's great. But other of you guys might want to know a little bit more, like, what is the big deal? And since everybody's supposedly, knows what they're talking about, you might not want to ask because you think that you should know too. But I want to talk a little bit about the Federal Reserve and really what it is that they do and why are they such an important aspect, an important part of what we're seeing today in the real estate market. So they're technically the central bank. They're central bank of the United States. And really their core mission is to keep the economy stable. And in order for them to keep that economy stable, they manage inflation. You might hear that term. I mean, we sure see a lot of that when we're at the grocery store. We see inflation regularly right now in our economy, which I know is supposedly the whole point of having the Fed to be able to manage that sort of movement. So we see inflation, we see employment, and we see also long-term interest rates being a really core mission of the Fed. Their purpose is to keep the economy stable. Now, the Fed controls what's called the federal funds rate. And really the federal funds rate is the rate that banks charge one another to transfer money overnight, to lend. So this is a constant movement that's happening. They're charging one another for overnight lending, and that influenced the cost of borrowing for you guys throughout the economy. So they use these tools to buy and to sell government securities, and they basically set reserve requirements for the banks to keep money flowing smoothly. So the issue that we've had that you've seen so much on the news is the fact that the Fed really is not supposed to be political. And we have seen it become somewhat political. I won't go into the political sort of, conversation here, but it's almost hard to separate the two because we've seen such a pressure being put on the Fed, which is supposed to be just the eyes, make sure that everything is stable, and this, I would say, like bickering that's been happening with the Fed and with our administration to be able to lower the rates. Why is that important? Well, that's important for quite a lot of things, but there's a lot of public sort of pressure during any sort of economic shift. It's no secret that we've had inflation. It's no secret that everybody is spending a lot more and trying to save whatever they can to make the dollar stretch. So as a result, what gets in the crosshairs? Well, quite frankly, the Fed. The Fed right now, because of the fact that the interest rates are higher than when people were used to during the pandemic, when you had, 2.5%, 3% interest rates, and then you're up to like 7.5%. It made it really difficult for buyers to be able to buy. So that's basically, that decision affects everything. However that rate goes is going to affect car loans. It'll affect credit cards. It'll affect mortgage rates and even the stock market. So because of that sort of movement, it has definitely become part of the political climate. Whether people are consider themselves political or not, you definitely feel that there are some very heavy opinions that are leading or have led for the Fed to not lower the rates. Now, technically, they lowered the rates by a quarter point, and that is important. It's an economic indicator. So we basically have that move that our current administrator right now, Jerome Powell, so he's the head of the Fed, and basically he wanted to make sure, basically see, okay, what's happening with the job growth? Is there things that are happening there? Is there a weaker job growth numbers? What are certain economic indicators for them to be able to say, yep, we need to lower the rate? And markets right now, the way how it stands, they are expecting 2 more cuts prior to the end of the year. I can tell you right now, just in our local market, I have seen more buyers come out of the woodwork. Really, they've been around. They just have not been able to buy. We can talk about property taxes another day, but we can also talk about the fact that everything is just so expensive. You have sellers holding prices, and then you have buyers that are not willing to pay because they can't. A lot of times they can't. You have the factors of not only the interest rates, but you also have the fact that salaries have not increased to be able to create this sort of, harmonious balance to be able to have an affordable home and be able to have money left over. So it's just created a really tense time in the market. It is certainly not a surprise. And I will say there are a lot of agents that have left the market, and I understand it's not easy right now. But at the same time, what does that do? This is not meant to be a doom and gloom sort of video, but it is somewhat to be a point of education, because this is where we are right now. I would say right now, there is some more consumer confidence that is starting to come about, especially with the fact that we do anticipate 2 more rate cuts towards the end of the year. So I want to go ahead and take a moment and talk a little bit about, this is like an economics class. We're going to talk a little bit about what consumer price index is, and also what is what's called the PPI, and that's the producer price index. So these 2 factors, you might hear CPI more than the producer price index, but both of these parameters work hand in hand with each other. So why is that important? We have the PPI this year. So far, it has risen 2.61% since last year. Well, Maddie, what is that? So since last August, according to the Bureau of Labor Statistics. So this basically measures from a business perspective. So imagine you're buying this fabulous cup, and you're going to buy this cup from the producer, from the person that created the cup. Well, they have to go ahead and buy it from somebody, whether it's a manufacturer or wholesalers. So they'll charge for the goods and services. They, meaning it tracks producers, manufacturers, and wholesalers when they initially buy something before it gets over to the consumer. I'm sure you're going to hear that. So why is that important? Well, what we're seeing right now, and why all of us have been dealing with inflation, is because of this particular PPI measure. Okay, so this is the business perspective. When you have a product that is going to come from somewhere and now is going to be passed on to a consumer, there's an initial cost to that. So if there's going to be, at this point, tariffs, this is where the big holdback was as far as the interest rates were concerned. Well, what was tariffs going to do? If tariffs were imposed and if this came from, let's say, another country outside of here, then you guys all thought of the same one, but I'm not going to say which one. If you bought this from somewhere else and you wanted to go ahead and sell it in a US company, then obviously that cost has to go somewhere. Is it going to be passed on to the consumer? Or is, at this point, the store where I purchased this cup going to go ahead and absorb that cost? So these are the two differences. Over here, you're going to have the PPI, which is basically the business perspective, right? So it's the producer price index. And then you're going to have the consumer price index. So the consumer price index is what we feel. This is what the customers actually pay. And this is mostly what we're aligned with on a daily basis, which is why when things are super expensive, then we might pull back on spending. So if the Fed is looking at the PPI, they're going to be looking at that producer price index higher. And if that producer price index went up 2.6%, that means that it's costing goods more for them to be manufactured before they're passed on to the consumers. And that's important because at the end of the day, when it comes to real estate, you're talking about every sort of, mortar. You're talking about steel, you're talking about the block, you're talking about all the components in a home that are purchased to be able to build that property. Who is going to absorb that cost? So is it going to be the builder, or is that cost going to be passed on to the consumer? So all of these things go hand in hand. It's really complex, but it's super interesting. And I just think that it's important for a consumer to understand a little bit about what was the point of the Fed? What is the big rigmarole regarding the interest rates? Because it's all tied really to consumer confidence. It's all tied to what we're seeing on a daily basis when it comes to paying, for goods and services. So why does it matter? Well, what matters now is the fact that we have tariffs into play. And this was one of the big holdbacks regarding Jerome Powell. I have my own opinions, but one of the excuses, one of the reasons I'll say that was said was because of tariffs. Now, the truth of the matter is we might not yet know 100%, and we don't know what is going to be the long-term effects of tariffs. I mean, I can go ahead and predict the way how we have economists predict that the tariffs in the long run are actually going to be beneficial to America, primarily because now this same cup is going to have competition. Number one, you're going to have more encouragement for American-made products to be manufactured in the United States as opposed to abroad. That's number two. And then, as you guys know, Economics 101, if I have two of the same cups and then I see that one is a little bit cheaper, hopefully that if that's the American cup, because you don't have tariffs on something that's made in America, then you're more likely as a consumer to pick the product that is made in the United States. So all of that is super important, and we don't know just yet what that's going to look like long term. And that was part of the hesitancy that was expressed by Jerome Powell to lower the rates. There was a lot of pressure, a lot of political pressure to be able to move the rates down. And it has finally happened to a bit, not to the extent I think that people were hoping. I mean, I've seen people talk about, well, we're going to lower, I'm not going to buy until it's down to 3%. I'm like, you're going to be waiting a while because we're probably not going to see that in our lifetime. That's something that is not going to happen overnight. Certainly not. But as we are today, right now, the Fed rate policy, it can't fully offset tariff-driven inflation. So since it's rooted specifically in the supply and trade cost, it's not necessarily consumer demand. So this is why it's going to take some time for us to really understand how this is going to play out. So if you guys are still listening, thank you. But I think that it's just super important for everybody to get an idea as to why all of that matters. Now, how does the Fed moving the rate, how does it affect everyday borrowers? That was hard to say. So the Fed fund rates, they basically affect short-term lending between banks. So they influence credit card movements, the rates that you're getting, personal loans, business credit lines. But it says right here that the rates themselves, mortgage rates, this is where things get a little crazy. They're tied to what's called the 10-year US Treasury yield. Okay, so I don't know if you've heard that particular term before. So when people say lower the rates, they're not just talking about mortgage rates because that doesn't happen right away. It is somewhat of a byproduct that can happen. But really, mortgage rates, they're different than when we're talking about the actual interest rate. Interest rates right now, they are tied to a 10-year US Treasury yield. It's not directly to the Fed rate. So what is the US Treasury yield and why does it matter? So the US Treasury yield at this point, it's the interest investors earn on US government bonds. Okay, and that mature in 10 years' time. So you mostly see that as an ultra safe sort of bet that you'll have people, whenever the economy starts to look like kind of shady and people don't know what to do, they want to put their money somewhere safe and they'll go ahead and they'll put it into bonds. So when that happens, people buy treasuries as a safety. And I would say a lot of people are starting to, not starting, this is like the oldest thing, right? Like getting gold and silver and getting minerals. So they'll put it somewhere that is going to be safe when they feel that there's uncertainty in the market. But what happens with that? It's supply and demand. If you have more people putting their money and trying to save their money into that, then the demand goes up. And then what happens is that the yield goes down. So it's kind of like this inverse relationship that we start to see. And what happens is that as that yield goes down, that's directly tied to the mortgage rates. So we're seeing this, we're seeing a direct relationship between both of those. So when investors, when they end up selling those treasuries, because they feel like, okay, they're seeking higher returns somewhere else because now the yield had gone down, then again, the yield starts to go back up. And then the mortgage rates start to climb. So it's a very interesting relationship that I think a lot of people miss that piece when it comes to understanding. When they talk about the Fed, it's not just the interest rates directly correlated with the mortgage rates. It's in fact the yield. It has to do with the 10-year Treasury yield. So in short, mortgage rates, they'll usually move in the same direction as the 10-year yield. So that's what you need to remember. So it's not necessarily in lockstep with what the Fed's actions are. So right now, the market's immediate reaction, what we've seen is that following the latest Fed cut, investors, they ended up really buying more into the treasuries. And so, of course, that ended up lowering that yield, their return. Okay, so it should be interesting to see what's going to happen. So what we do know is that once that happened, what was the first thing that happened? Mortgage applications, they rose 30% because people felt, okay, this might be a good time for me to get that house. And they actually saw a rise in mortgage refinance. So people wanting to refinance, that demand actually went up 60% within the week. So that's pretty amazing. Which tells me that a lot of people probably bought. I remember in October of 2020, what is it? I'm dating myself now. But really, it's been over a year. Last year, I want to say, when things were at about 8%. So if you have right now, I was talking to a lender friend of mine that he was able to lock somebody in at 5.75. So there's a lot of positive news as far as what the market is starting to do now. A lot of those buyers that are sitting on the sidelines are starting to come about. And I think that really a lot of the people that were able to purchase and were really under the whole premise of date the rate, that whole term came about because people said, well, I have to move. I have to be able to get into something now. And later on, as the interest rates go down, I will go ahead and refinance. And that was really a great strategy for people to get really great deals on the market because you have sellers that have been wanting to offload their properties for circumstantial reasons, and they're willing to negotiate. So it's going to be interesting to see how the year is going to wrap up, because as demand is still there, people are just waiting on the sidelines to find that magic number. But really, do they have to? You can jump in at when you can, and if in fact the rates start to go down further, if it's worth the while, you could always refinance. Now, at this point, some people are getting quite creative when it comes to what they're doing to be able to jump into the market. So we haven't seen since 2008 what's called adjustable rate mortgages. They've always been around, but it really wasn't necessarily a very popular product when interest rates were so low. So with an adjustable rate mortgage, you have an initial you have a lower rate. So let's say right now you're sitting at about 6.25 for interest rates. Generally speaking, you are about 0.75% lower in interest rates based on the going rate than a traditional 30-year fixed cost. So somebody could say, hey, I'm just going to do, a 5 to 7 year ARM. So what that means is that within that amount of time, you're going to really be able to have that lower rate. So let's just say instead of it being the 6.25, now you're at about, 5.25 or 5.5% interest. And then that puts you at a more comfortable mortgage rate, but it's not for the 30 years. It's just going to be for a fixed amount of time. So generally speaking, 5 to 7 years is what we see in the initial ARM. And the plan for a lot of people, which should be the plan, is that you would refinance at that point, because what happens is that it then will escalate into whatever is the current market rate. And that could be a really great strategy for people that know that they just need something for the now, and they will plan to either move later on within, the 5 years, or refinance at that time. Americans are by far one of the most transient sort of people. I mean, we have so many great states to choose from. So this is always a great option for somebody that wants to get into a house, but not go at a higher interest rate as what might be the current day interest rate. So some of the things as far as realities are concerned, we're looking as inventory in Florida has continued to go up. We have also seen a lot of buyers, starting to, they're going all over the place. I hate to say it, but we have so many people that we call them halfbacks, because they'll end up coming to Florida for a little bit and then they'll go off to Tennessee. And I've seen some people actually come back for weather purposes, or, there's just, I always find it amazing to see how people move and the reasons why they decide to come in and out of Florida. Now, I can tell you, as far as Central Florida, you guys have seen, if you follow me from before, we definitely have had an increase in population since really since pandemic. Pandemic really brought about such an influx of people from up north. We are still seeing that now. I would say due to the political climate throughout the United States, people are seeking different sort of states that they might feel is more favorable to align with what it is that they might look for in a government. Now, I can't wait to see what's going to happen as far as Ron DeSantis is concerned when it comes to property taxes. That's a very interesting conversation. We'll see what happens, but I know there's been a lot of talk as far as him really putting his name on the idea of wanting to decrease or get rid of property taxes for people that have homestead. So that would definitely be a plus when it comes to the market, when it comes to other people that are really burdened by the property taxes in their states. And I'm sure that we'll be seeing a lot more people want to make this their home if that in fact does happen. It will be interesting to see how many other states do follow suit in regards to that. So right now, what is the magic number? So the magic number, what are buyers waiting for? What are they waiting for? What's going to be the magic number for people to jump into the market? And apparently economists really believe right now that the mortgage rates starting with a 5, that it'll trigger a wave of pent-up demand. And I can agree with that. I have had people that have definitely said, well, you know what? If it's at least halfway there, not at 7, and it's not going to be at 3, but that seems to be the sweet spot that some people feel that would be able to be something that they can technically afford. So we'll see what's going to happen there. The overall trend right now, as those rates fluctuate, we're going to start to see more people jumping back into the market as it gets closer to that number. So annual sales right now, they've hovered around 4 million. And that's technically the lowest that we've seen since the mid 1990s. So, but I will say that there is a lot of optimism building as far as what 2026 is going to offer. I would say right now, things take time. I mean, even when it comes to an appraisal, when you're talking about the values, when I have a listing and I set a price, I'm looking technically at what sold last. So those are the comparables that we can go by, not what is active on the market, but technically what has previously sold. And if things have been sitting on the market for a long time, that number becomes more and more skewed, because remember, it is not us that determines the market determines the market. And whenever we're starting to see these movements in rates and what people can and can't afford, direct with inflation and all the other sort of economic factors, that's really going to be what's going to tell somebody, yeah, make me move. So 5% could be, in fact, that magic number that will have a person say, okay, it's time for me to move and I'm okay, or we can negotiate on price. But because their monthly mortgage is going to be at a lower amount, they might be more willing to make that move. So right now, there has been talks. Not talks. We are currently in a government shutdown as of this video anyway, and we'll see how long that lasts. So of course, right now, that basically, there's some data that we don't have as far as numbers are concerned, but what we do know is that there does seem to be supporting evidence that we are going to have another Fed rate cut. Because if we're starting to see that the jobs report, the official jobs report, which hasn't come out yet because there's a delay because of the shutdown, but a lot of people, and the word on the street is that, yes, we are in fact going to be up for another Fed cut. So remember, a Fed cut doesn't directly lower mortgage rates. Remember that, okay? But it does help create a favorable market conditions for there to be one. So keep that in mind, because I know it drives my lender friends nuts when people say, oh, we got to lower the rates. And then they initially think that it has to do with the interest rates, but it doesn't. It's two different things, but it can help provide a favorable environment to bring about a rate cut. So that's something for you guys to keep in mind. So right now, it says here, this is actually a survey done by Realtor.com. 40% of potential buyers, they said that they would re-enter the market if the rates fell below 6. If the rates fall below 6, then 40% of potential buyers would enter the market. So what does that look like as far as numbers? On a $500,000 loan, so a drop from 6.34 interest rate to 5.99. Okay, so that's just on the edge there. That savings is about $113 a month. Okay, so it would be $1,356 a year. Of course, there's taxes and insurance that you would have to add to that. But generally speaking, as far as your mortgage, as far as what that number would look like on the loan itself, that would be the difference, $113 a month. So basically, what can people do today to be able to give themselves some of that leverage? Well, I would say there's two viable options. One is, of course, new construction. New construction right now has been the absolute winner within the last year. They have been able to really, I would say, beat the pre-owned market. I know I've had listings that have been close to some new neighborhoods, and they haven't quite been able to compete. So one of the things that you have to understand is that some of the bigger builders, they do have their own financing company. Now, because they have their own financing company, they in turn can absorb some of that cost. They can absorb that movement in the market. Remember when we were talking about buying it and then passing that cost on to the consumer. Well, that's what happens. It happens very much all the time with new construction. They're going to have more power of the purse because they own not only as far as construction is concerned, but they're also own or they have connections with their own financing companies. So every big builder is going to have a certain margin to be able to offer closing cost assistance, to be able to offer incentives. And that's something that when you're talking, well, I'm talking to a seller, their margin might be smaller. It's not going to, they just can't compete. They cannot compete always with some of the big builders that are out there that have been outsmarting the market when it comes to interest rates. So I've seen a lot of people, a lot of buyers that have decided to go with a bigger builder for that reason. Now, it might not be their forever home, but if they want to start off and be able to buy a property for their family, then it is a wonderful way for them to be able to get their foot in the door into a property, because the interest rates that are offered through some of the banks that are owned by the big builders are going to be much more favorable. So that's been something that we have seen within this last year as far as new construction is concerned. Now, let's say that you don't want new construction, because one of the biggest drawbacks that I have seen with buyers is that they want more land. They love the house with the character. They don't care to have, just a small lot, because they actually, maybe they don't like the HOA, or maybe they just want to be able to be a little bit further remote out in the country somewhere. So there's a lot of reasons why people might not want to be in one of the communities that are new construction. Well, are there any solutions? And yes, there are. Now, I would love to be able to give you more information on that. I work with a lot of excellent lenders, but one of the things right now is as far as a temporary buy down program. So a temporary buy down program, it basically offers a buyer a 1% rate reduction in the first year of them having the property. So it's really a practical way for you to own a home. If you're thinking about new construction for the sake of the rate, but you really want the house with more land and out a little bit further, then there are actual lenders that can offer you very creative programs out there. And this 1% rate buy down is one that is actually offered. So if you'd like more information, go ahead and I'll put my information, within this video, so that go ahead and put it down in the comments. I'd be interested to hear if you guys are aware of any other programs out there, because I know that there are many. Depending on the lender, depending how big they are, they're also able to offer different products. So it's not always a one size fits all. I think depending on the circumstance, your debt to income ratio, when it comes to your credit score, your credit readiness, worthiness, then all those things do matter as to what you're able to qualify for in the programs that the different lenders can offer. So I think right now, rates right now, they're expected to stay relatively the same this week. And so we'll see, depending on what's going to happen and how this week starts to shape up. But I wanted to just take the time right now to let you guys know that at this time, lower rates can help. So right now, confidence in the market, I think that that's going to be something that's going to continue to flourish as we get closer to the year's end and into 2026. And really think about buying and shopping around as far as your rates. See what different lenders have to offer. I work with a lot of tremendous lenders, and go local. Work with local lenders. I would always make that suggestion. I have many a story to tell you within this last decade of things that have not turned out so great because of the fact that buyers have used lenders that have zero idea about the Florida landscape. So if you have any questions regarding that, I'm Maddie the Realtor, and I really look forward to being able to provide further information for you guys. And if you're here to the end, then cheers to you, and until the next time. Thanks so much. Bye.